On today's episode, we are going to take a look at three growth stocks. The first two we're going to take a look at have pulled back a nice amount from their all-time highs. The first one is in the real estate market. The second one is in the exercise market. The third stock we're going to take a look at is pretty interesting. This is a recent IPO, and we're going to learn a little bit about it in today's episode. Like always, if this is your first time here, make sure to hit the subscribe button. Don't forget to hit the thumbs up, and make sure to stay tuned where I live stream here on YouTube, taking a look at stocks you want me to look at. So let's get started. But before we begin, let's take a listen to today's sponsor. I want to thank the Motley for sponsoring this video. Motley is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You guys know I love finding new investing tools and resources to help me scout out new growth stocks. And right now I have a discount for one of my favorite services the Fool offers. Through the Motley Fool Stock Advisor services, you get access to a ton of expert stock picks. Every month you'll get 2 new picks that are aimed at growing your wealth and to help you realize your financial goals. Stock Advisor's average stock picks have done amazing returns. If growing your money is something you'd like to do more of this year, you can visit fool.com/Jose Najarro or click on the link below for access to my special offer and decide if the Stock Advisor is right for you. Thanks again to the Motley Fool, and now onto today's video. Right, so the first company we are going to take a look at is Opendoor. Opendoor is the one in the real estate market. This is a way to sell your home from the comfort of your couch. So here's how Opendoor is a bit different compared to some of the other realtors, online realtors out right now. The first one is you can sell directly to Opendoor. You take your pictures of your house and you can get offers within minutes from Opendoor. And this, you get to skip the whole hassle, right? You get to skip the repairs, you get to skip the showings of the houses, and you're able to schedule when you want to close on the house. The second way is your traditional way where you can list your house through Opendoors, and then Opendoor collects a form of fee through this process. So if we take a look at Opendoor, this is currently traded under the NASDAQ as ticker OPEN, and it has a market cap of $10.83 billion. Right now, as I am recording this video, it is sitting at $18.64. It is up about 1.8%, but we can see from its all-time highs, the stock is down about 47.9%. So it's definitely seen a crazy pullback. So some cool things to note about Opendoor is right now they're only in 21 markets, and this is just scratching the surface for them. Within these 21 markets, this represents only about 2% of the market share, and it currently for quarter one of 2020, it represented a run rate of about $5 billion. Their current playbook takes them to about a $50 billion run rate revenue, and this is expanding them to 100 markets. This still only represents about 4% of the market share. So we can see these real estate companies are still pretty early on in this market. And just by growing their market share little by little, the amount of revenue that they can grow is insane. So before COVID, Opendoor was experiencing some strong growth. Between 2017 and 2018, the amount of homes sold was up about 145% compounded annual growth rate within that time frame. Revenue was up 159% within that time frame, and adjusted EBITDA margins were improving over time. In 2019, they were about 4.6% at a loss. But now with COVID situation, obviously that has changed a lot. For example, their most recent quarter, which they did announce in March, I believe, total homes sold were 849 compared to 5,000 the prior year. So it does seem like COVID has affected the company a lot, and this is something to keep in mind of how long will it take for them to see that type of growth that they were seeing before. Total revenue was about $250 million this most recent quarter compared to $1.2 billion a year ago. Same with the amount of total home sales for the full year of 2020 was cut about half, but for the first quarter of 2021, Opendoor is going to announce here on May, within the next few weeks, they expect revenue to be somewhere between 600 and 625 million. This is going to represent about 146% growth compared to last quarter. They're expecting home sales to increase back up, but still nowhere near the levels they were in 2019. A few good things is the company expects to launch 6 new markets in quarter one. Regardless, with that growth, they're still expected to be negative in EBITDA margins, about 5% loss. If we take a look at fundamentals, Opendoor is expected to grow 32% on average its revenue for the next 2 to 5 years. This is a hyper growth stock for sure. If we take a quick look at their balance sheet, the company has $1.5 billion in cash and they have about $500 million in debt. So even though they're not profitable, or at least have a long experienced time of positive cash flow from operations, they have a strong balance sheet, and this is going to allow them to continue that growth rate and start to expand into more markets. If we take a look at analysts, there's 4 covering open right now. All 4 of them give it a buy, and this is a strong buy right now. The average price is about $36.50, which represents about a 99.30% uptick from where the stock is at right now. Like always, at the end of the episode, I'm going to share my overall thoughts and like what tier I would put each company. The second company we are going to take a look at is one that has been on the news recently. This is going to be Peloton. We all know Peloton. They sell their bikes, they sell their treadmills. They have apps where they have courses and classes, accessories as well that go for their bike and for the treadmill, and finally apparel. Peloton is currently traded under the NASDAQ as ticker PTON and is sitting at about $101. In the past 6 months, the stock has pulled back a nice amount, about 39.73%, and it has a market cap of about $29.7 billion. Right now, Peloton refutes the Consumer Product Safety Commission claims. They're not going to stop selling their bikes. They believe that their bike is safe, and many people online believe that it wasn't Peloton's fault. Outside of that bad news, Peloton in the past few months has definitely had some great news, right? In the April 1st of 2021, Peloton completed its Precor acquisition. With this acquisition, Peloton will establish U.S. manufacturing footprint. It anticipates enhancing its R&D capabilities and accelerating the growth of commercial verticals. So great news for Peloton in that regards. They're also in March of 8th, a few months ago, they actually announced the expansion into Australia, and this is the brand's entry to the Asia Pacific region. Peloton right now is expected to grow 25% on average for the next 3 to 5 years. Its revenue, it is positive in earnings, it is positive in cash flow from operations. So fundamentally, the company is looking pretty great, especially when you take a look at their balance sheet. On their most recent earnings, they reported about $2.1 billion in cash, no debt to their name. Maybe with this acquisition, it might change a bit, but we'll see in their most recent earnings. Currently, there's about 24 analysts covering Peloton. About 19 give it a buy, 4 give it a hold, and 1 gives it a sell. So pretty much a strong buy right now. The average price is $161.38, which represents a 51% gain from where the stock is at right now. So you can see analysts are very, very bullish. The third and final company we are going to take a look at is a brand new IPO. This is TuSimple. TuSimple is a company where they develop the world's most advanced self-driving technology, specifically designated to meet the unique demands of heavy-duty trucks. And there's some crazy information that I didn't believe, right? We're going to take a look at that in a bit. But right now, this is currently traded as ticker TSP and is currently sitting at $38.08. It's a recent IPO. I think it's not even a few days. April 15th was its debut day, and it was at about $40. The company right now with the most recent IPO has a market cap of about $8.1 billion. So it's not a crazy big company, but it's definitely not a small one either. The most recent IPO brought the company about $1.3 billion in cash. And this cash that they built up is very important because so not much revenue is coming from TuSimple. This company is still burning cash. So it's a great news that they do have cash at hands at the moment to be able to continue this improvement in technology. TuSimple has a lot of great partnerships with some big players in this market. And one of the great things that their CEO did mention is that right now they have about 5,700 reservations for their technology by just one of that big player. TuSimple has a pretty crazy expansion plan. And when you look at it, when I first saw it, I thought it was insane. I didn't know what I was looking at. Their phase 1 is pretty much one that they want to implement between 2020 to 2021. And this is to have some form of autonomous vehicles in the south region, here in like Texas, in Arizona, in New Mexico. And when I saw this, I was like 20 to 21. Am I reading this correctly? And yes, this is true, right? If you go to their YouTube channel right now, you can just go to TuSimple, and they have a contract right now with UPS where autonomous vehicles are actually driving between destinations. There is a twist behind it, right? Since it's not fully automated and because of multiple laws, there has to be a person inside the vehicle with it. So right now it's just more of a proof of concept within this year, and you see it, right? The truck is driving itself throughout multiple hours. The only thing is you just have a driver kind of not even having their hands on the wheel, but just ready to take the wheel in case anything happens. But regardless, I thought that was super impressive. Phase 2, they want to expand more into the southeast region, and that would be between 2022 to 2023, and between 2023 and 2024 they want to expand more into just the whole northern side of the United States, from the east to the west coast. So this is pretty impressive, right? At the same time, we have to remember, right, TuSimple, this is a technology that's brand new. This is a stock that I would put as a speculative play. This is a company that has no revenues, that has no positive earnings, that has no positive cash flow from operations, and it's not intended to have that until maybe 2024 and 2025. So this is one of those companies that is a highly speculative play, in my opinion. And right now, there are obviously no analysts taking a look at TuSimple, since it's just a brand new company in the public market, and it's also a company that at the moment, like I said, it's in early stages. Another thing to note, though, is there are a few investments from TuSimple from the China region, and some investors are using that as a bearish thesis for the company. Makes sense, right? And again, something I just want to put that out there for TuSimple. All right, so now let me share my overall thoughts. First, I don't have any ownership in any of these companies, but if I were, let me kind of rate them, right? So TuSimple, if I wanted to get into TuSimple would probably be a tier 3 stock no matter what, right? This is a highly speculative play. They have no revenues, they have no earnings, and this is a market that is still early on. If they do grow, this could be a great winner, but at the same time, it will be one that will be very volatile because, again, no revenues. They do have a strong balance sheet, which is great news for them, and they do have partnerships with some big names. Next, let's take a look at Peloton. Peloton, I used to have it in my portfolio. I don't have it anymore, but Peloton is one that if it was, it would be somewhere between a tier 2 to a tier 3, maybe a mixture of there. It wouldn't be a high tier 2 for sure, even though Peloton, right, they have strong earnings, they have strong positive cash flow from operations, a strong balance sheet, they're expanding. Overall, that whole market, the whole fitness market, not something that completely interests me, but the company as a whole, strong fundamentals, even analysts give it a strong bullish rating. Next, we have Opendoor. Opendoor, I think I would put it in the same place as Peloton. Maybe even a smaller position than Peloton, but a bigger position than TuSimple. And again, Opendoor, this is a market that has definitely been hit hard by COVID situation, unlike Peloton, which actually benefited from it. Opendoor, quarter ones are pretty soon. We're going to see what kind of markets they're expanding and how much growth they're seeing compared to last quarter. Opendoor right now, we saw, is not profitable either, but they do have a strong balance sheet, and that's a great thing. It allows them to continue to do what they're doing. So I hope you guys enjoyed today's episode. Like always, make sure to hit the thumbs up. Take care and see you next time.